China has once again reduced its holdings of U.S. Treasury bonds, hitting a 16-year low. Is this a strategic signal or an economic necessity? Let's dive into the details. According to the U.S. Treasury's latest International Capital Flow report, China cut its U.S. debt holdings by $8.2 billion in April, bringing its total to $757.2 billion, the lowest since 2009. This marks a 3-year decline, with China shedding $173.2 billion in 2022, $50.8 billion in 2023, and $57.3 billion so far in 2024. Experts say this reflects China's push to diversify its $3.2 trillion foreign exchange reserves and reduce reliance on the US dollar. Meanwhile, Japan and the UK are boosting their US debt holdings. Japan, the top foreign holder, added $3.7 billion, while the UK surged by $28.4 billion, overtaking China as the second largest holder. Overall, foreign investors hold $9.013 trillion in U.S. debt, up 12% year-on-year. Professor Sun Guoxiang from Taiwan's Nanhua University says China's gradual sell-off is a signal of discontent with U.S. policies, but a massive dump is unlikely. Large-scale selling would devalue China's own assets, hurting itself more, he warns. Professor Frank Tianji of the University of South Carolina, Aiken adds, U.S. treasuries remain unmatched for liquidity and safety. China can't fully abandon them. Analysts point to two key drivers: China's push for yuan internationalization and economic pressures like declining exports and a strained yuan. However, experts doubt the yuan can challenge the dollar's global dominance due to issues like limited convertibility and low trust in Chinese assets. The U.S. remains unfazed, with officials noting the Treasury market's depth and strong domestic demand, with 76% of U.S. debt held by American investors. As China navigates this delicate balance, the world watches closely. Will this reshape global finance, or is it just a cautious recalibration? Stay tuned for more updates.